Good afternoon, everybody. My name is Melvin Escudero. I am the chairman of the Advocacy Council for Latin America and the Caribbean markets. It is my pleasure to welcome you to this very important webinar about policy series, Latam and the Caribbean. With this initial one, we will cover the Brazilian and Argentinian market. We are very grateful with our keynote speakers, Daniel Maeda from the Comissão de Valores y Mobiliários, CBM from Brazil, and Alejandro Garnet from the BYMA Bolsas y Mercados Argentinos, the stock exchange in Argentina. We are very happy to have you as keynote speakers and also to all our panelists and moderators for this 2.5 hours webinar. As you know, Latin America has big challenges. It's not only about prosperity and growth, but it's also about the development of new sources for financing. During the last 2 centuries, the financial system, especially the banking system, has been very strong doing this work. But recently, in the last 30 years, we have seen a very huge growth of capital markets, especially in the largest economies like Brazil. Right now, we are in a balance between 80 to 20%. 80% means banking financing and 20% capital markets financing. We are expecting in the next future steps and growth and deepness of the development in capital markets. And the regulators and the stock exchange clearly are the leaders of this process. So we are very happy to start these webinars. It's a series of policy webinars that in the next month, each couple of months, we will have another webinars like for other countries like Uruguay, Chile, Peru, Colombia, Mexico, Jamaica, and other societies that we have in the Caribbean region. So in aggregate, we are planning to do this year a revision of all the initiatives and proposals that the markets and the regulators are putting on the table to enhance our development. In this process, CFA Institute wants to help. And for that reason, we have now, since this year, a new advocacy council for the region. Each society, out of 13 societies, have a coordinator for the advocacy council, and we also have from the CFA Institute an advocacy representative. And this reorganization will give the institute more material and more breadth to help the different countries to develop and help them on this process to introduce best practices and other important issues that could create momentum to accelerate our growth and development. So I'm very happy to be with you. I will introduce now Sandra Peters, who is from the CFA Institute. She is the head of the Financial Reporting Policy Group for the welcoming words. Go ahead, Sandra. Thank you to be with us.
Great. Thank you, Melvin. Can you hear me okay?
Yes.
And see me? I've had a little issue with my internet, so hopefully we're good.
Yes, it's good.
Thanks for inviting me to participate. As you said, my role at CFA Institute over the last decade actually has been as the head of our global advocacy efforts related to financial reporting. I'm a CFA charter holder and have been for a long time. But prior to that, I was an audit partner with KPMG and corporate controller for MetLife. My team and I advocate to standard setters and policymakers and regulators globally for information that's useful for investment decision making. In recent months, as we've been in a period of transition, I've looked after our advocacy efforts more broadly, globally. So Inigo asked me to provide some context for CFA Institute's advocacy efforts as part of and as a backdrop for this webinar. Just a little bit of background on how we actually do our advocacy efforts. So CFA Institute's advocacy efforts focus on topics associated with both capital markets and financial reporting, with the latter being more corporate disclosure and increasingly ESG related matters. Our capital markets efforts are regional, with a capital markets team that's focused principally in North America, with advocacy activities in the US and Canada. And Inigo Bengoechea and Rafael Matallana have been working with the societies in Latin America on advocacy efforts in this region. But we also have advocacy teams, an active team in Europe, both in London and in Brussels, that looks after the Europe, Middle East, and Africa. And we have a team in Hong Kong and Mumbai that engage in advocacy efforts in Asia Pacific, which is a large regional area to cover. The capital markets folks in these teams are working with a plethora of organizations globally on issues affecting market structure, corporate governance, transparency, sustainability standards, and a variety of other topics. Although the same can be said about Latin America, our efforts have been more focused in promoting the development of capital markets in the region. Additionally, as of late, we've been placing stronger emphasis on the importance of ESG adoption as a means of attracting foreign investment in Latin America. And these efforts, coupled with our society's aspirations to drive deeper regional integration and regulatory harmonization, should help raise standards and bode well for investors in Latin America. So those are our capital markets efforts, and they're principally regional, but our financial reporting efforts are principally global, with consideration of efforts related to the International Accounting Standards Board on International Financial Reporting Standards, or IFRS, the Financial Accounting Standards Board, or US Generally Accepted Accounting Principles. In broad strokes, our financial reporting or corporate disclosure advocacy efforts are sort of the globe and the US. And not only for accounting, but also for audit policy making. We work with the US regulator, the Public Company Accounting Oversight Board in the US, and we work with international organizations that deal with auditing, including the International Accounting and Auditing Standards Board. So both financial reporting and capital markets work with a wide variety of organizations globally on sustainability standards as of late, with Europe having a desire to lead on this agenda from a civil society objective, and the US getting more into the debate with the change in administrations, the presidential administration in the US. So that's sort of broad strokes of how we organize ourselves. We have about 15 to 20 people globally who look after our global advocacy efforts at CFA Institute centrally, and we're always looking for collaboration opportunities with societies in all the regions to deliver our centrally developed messages locally and to assist centrally with topics of local interest. So that's how we do our advocacy efforts, and explains how I fit in and how we go to market. But I think it's most important to talk about our objective as it relates to advocacy. CFA Institute devotes substantial resources to advocacy, as our objective is to improve the integrity of markets for investors globally, ensuring that investors not only have the proper information to make investment decisions, so what I do, and that the markets, including their structure, regulations, and participants, work to ensure buyers and sellers meet for a fair exchange. And that's principally what the capital markets group does, but we work together. The best part of our work, and sort of what's kept me here longest, and I think as you all endeavor in advocacy efforts, is that the work is highly purpose-driven. We're basically, as I say, disciples for free and fair markets. And one of the best things I like about my job is that I can see the work that I've done over the last decade has improved information for investors globally. So though we lose a lot, as we have powerful stakeholders with other objectives, we have the benefit of fair markets and higher purpose on our side. So in the long run, we win. A little bit on our advocacy approach. So our advocacy approach, when we started out with advocacy more than 60 years ago, was reactive and principally focused on financial reporting, where we responded to consultations or rules being proposed by regulators, legislators, standard setters, or other policymakers. You can actually trace the history of CFA Institute to the Securities Acts in the United States in 1933 and 34, and the proliferation of information globally. Over the last decade, however, our approach has become more proactive. We've engaged in thought leadership and research on issues we see as emerging and where we want to influence regulators, legislators, standard setters, or other policymakers, as well as those who are actually trying to influence against us on our views in advance. We try to do it in advance of any proposal or rulemaking or consultation by regulators, so we can help set the table as opposed to react to the table. And we've done that on a lot of issues, on capital formation, dark pools, non-GAAP measures, forward-looking information, a host of other things. We also not only do advocacy and try and influence, but we also try to educate our members on the advocacy we're doing on their behalf, be it on MiFID in Europe, or ESG integration in investment decision-making, as well as things like putting leases on the balance sheet and financial statements. So we create the content, which is comment letters and thought leadership, that forms the basis of our advocacy with policymakers. But we also meet with them to share our perspectives and educate, as well as influence towards the outcomes we think are important towards our objective of free and fair markets. So as a part of these engagements, we seek to have rulemakers cite our work to participate in seats at the table on advisory committees, so we can share our views real time and influence other perspectives. But as I said before, many times they're vested constituencies influencing regulators towards their commercial interests, and the debate becomes very political. As I tell my friends, that my job is not about accounting, it's about politics and communication. So I joke sometimes when people say that we study and we write about deeply technical issues without sort of realizing that at the center of advocacy it's heavily about building relationships and educating stakeholders, all kinds of stakeholders, to the policymaking process. And sometimes we define success as stopping bad rules or changes and not eroding investor-friendly rules, like in the US under the prior administration. But now with the change in administration, we define success as trying to seek an advanced rulemaking. So it's sort of the administration in politics changes what our definition of success is. So in addition to the content that we do, we also do a variety of awareness activities, including articles and blogs and speaking engagements, as well as talking with the media, as we do frequently. I just talked with the Wall Street Journal, for example, this morning. And we have a lot of industry meetings, so we understand how all the stakeholders to the process feel. And some of our efforts take a very long time. I actually have a nice picture of how on the accounting for leases, it's taken us since 1970 and all the things we've done to advance those outcomes. But we like to look at how these activities compile to outcomes over time. So that's the gist of what we do, why we do it, how we do it, i.e. in content and awareness. So just to today's webinar, as Melvin said, this is the first in a policy series in Latin America. And we're delighted, I'm delighted to be able to participate and give you a high-level view of how we think about advocacy at CFA Institute broadly. And we're delighted to have two high-profile speakers from the Securities Commission in Brazil and BYMA, the stock exchange in Argentina. Both the keynote speakers will be speaking to issues that are top of mind in their respective countries, with Mr. Maeda focusing on ongoing consultation on investment fund reform in Brazil, put forward by the Commission, and Mr. Berney discussing some of the regulatory pressures for issuers occurring in Argentina. Following each of the keynote speeches, we'll have a panel discussion with industry experts to bring additional perspectives from the ground. And we hope you enjoyed the policy series and welcome. And I'll try and stay on if anyone has any questions at the end for me about sort of how and what we do at CFA Institute. So with that, I'll turn it back over to you, Melvin.
Thank you very much, Sandra, for your interesting comments. Now we will start our first focus on Brazil at this panel, and we invite Daniel Maeda and his moderator, Ruth Walters, who is member of the board of the CFA Society Brazil. Go ahead, Ruth, with the introduction of our keynote speaker, and welcome to our webinar.
Thank you, Melvin. Good afternoon and welcome to our first policy series for Latin America and the Caribbean. I am Ruth Walter and I'm a board member of CFA Society Brazil. Today, I have the distinct pleasure of welcoming our first keynote speaker, Daniel Walter Maeda Bernardo. Daniel is currently serving as the Superintendent of Institutional Investors for CVM, the Securities Commission in Brazil, Comissão de Valores Mobiliários. As superintendent, he is responsible for overseeing the fund industry in Brazil, which manages more than 6 trillion reais and is composed of more than 3,000 service providers. He has worked at the Comissão de Valores Mobiliários since 2005. Welcome, Daniel. It is a pleasure to have you in our first policy series.
Thank you, Ruth, for your invitation. On behalf of the CFA, I would like to thank all of you for this chance to exchange some ideas, some thoughts. Great opportunity for us to explain a little bit more about our regulation improvements we estimate to put in place this year. So once again, thank you.
So thank you. We understand you have been very busy the last couple of months following the CVM decision to open a public hearing to modernize the investment fund rules, currently regulated by Instruction 555 and the FIDICs, Credit Rights Investment Funds, regulated by the Standard 356. The public hearing, which was anticipated due to the changes to the Economic Freedom Law, Lei da Liberdade Econômica, have resulted in CVM making wide-ranging proposals to modernize the sector. So what can you tell us in general terms about the public hearing, and what is CVM looking to achieve for the investors and for the market?
Yeah, what could I say about that? I think we have now CVM as a regulator and the Brazilian capital markets, specifically, of course, the investment fund industry, a good, a distinctive opportunity to, to leverage, the products and, the service they provide and even the size of our industry. It's already big. It's already really huge, but it still can grow a lot based on this innovation brought by the economic freedom law. Just because there is a common sense here in Brazil that this law tried or was inspired in the attempt of getting closer international standards in terms very common abroad for investment funds in other jurisdictions. So, for instance, the limited liabilities for investors, which is, really very, very common, is also, it's a standard in other countries, and now we have a legal provision for that, for such here in Brazil. The classes of quotas as well is another example of that. So we really have now new features or new tools for the investment funds in Brazil to make our industry even more attractive than it already is. So it's really a good chance for us, and of course this this work cannot be done by the CVM alone, and that's why we, of course, issued a public hearing about this issue to hear the market, to get the suggestions and take the best of this all these suggestions. I think we can really during this year, 2021, take this chance to make the more effective this innovation. The law become the law innovated now, and once again think on new products, new ways of structuring investment funds for investors that are seeking. Yes, it's true. It's a new scenario here in Brazil. In a good scenario and a good context for this law, there is a demand from the investor side for new products that can, offer more alpha for investors or offer more exposures, new kinds of exposures, international exposures, for instance, for investors. They are really searching for that. So. I do think in the investment funds in this new scenario that we are, just passing by here in Brazil, they can play a really very important role. They already play a very important role in Brazil, of course. That's the most important and the most representative product for the retail investors here in Brazil. But they really can, be even more representative in this sense. I think, especially based on these innovations brought by the law. That's my opinion. That's how I think this process is going on, because of the the innovation by the law.
Excellent. So now let's dig a little deeper on the proposed changes, specifically those affecting the investments abroad, that you mentioned, the international investments. How would the new regulation make the investments abroad more flexible?
Yeah, sure. That's a really very interesting issue, as you may be aware, CVM has been improving our regulation in terms of investments abroad since 2007. So I would say 15 years flexibilizing even more investments abroad. But of course, we do have our concerns, we do have our issues when we try to flexibilize this kind of investments. Of course, it's a good innovation for investors, just as I mentioned, in terms of more alternatives, more diversification, and more alternatives for the Brazilian investors in terms of risks and returns, of course. And so it's a good idea. No one doubts that. But an investment abroad and investment in another jurisdiction involves some new kinds of risk, let's say. So our approach has always been, gradual, has always been, a step at once in terms of what to flexibilize. And now in this public hearing there is on the run, we do have some new ideas in terms of new products and new kinds of international exposures for the Brazilian investment funds once again. And of course, this is not correlated to the Food and Economic Law, specifically speaking, but we do know and we do agree that it's a trend here in Brazil for us to have more international products, let's say, for the Brazilian investors. So some of the innovations we are studying in this public hearing, in this proposal, relates, for instance, the mirror funds target at retail investors. They are not allowed up to date. Mirror funds, funds that replicate 100% an international fund, a fund from Luxembourg or United States or whatever. They are not allowed up to date to retail investors, and we put in place in this proposal this innovation. Of course, according to certain requirements and certain criteria. Funds that are structured abroad in other countries may be targeted at retail investors here in Brazil. So it is a relevant, step forward in that sense. And this new possibilities of products target or investing in the Brazilian BDRs, as you may know. The BDRs level 1, specifically speaking, this is another example of another innovation in our proposal. So once again, points to make the market think about it once again, and of course answer our proposal in the sense of they make sense. Answering these questions, they make sense. These proposals make sense. What other kinds of proposals may make sense, and if it's the case, please don't hesitate to do it, to propose something different or something additional to what we put in there in our public hearing. So it's a big issue, and I would say it's a kind of discussion that is eternal. I think we will have some other rounds in the near future, thinking over again and over again about new projects or new ways to allow investors in a safe way to be more exposed to international assets, international risks.
Very good, thank you. And now we are also interested in hearing about the changes on share classes. We understand the economic freedom law allows funds to be a great umbrella covering different share classes with distinct rights and obligations, without, however, mixing the assets with one another. For CVM, the possibility of setting up segregated assets within the same fund with different share classes offers new opportunities with more flexibility and reducing costs for structuring new products. And so what insights could you share with us, please?
Yeah, sure. Wow, this was one of the most, most thoughtful and challenging issues we tried to manage and deal with in this proposal. Of course, this possibility, this new possibility of classes for the fund quotas is something that shakes the structure of our investment fund industry. It's really an invitation for rethink all the industry in how the industry is positioned and how the products are offered to investors. So we try to do our best in that sense. I think the most, the main concept involved in this issue, in this matter, was trying to segregate what would be the classes that would separate portfolios and the classes that would congregate or not separate the portfolio itself, but a same portfolio with different classes. So and the way we found to separate this different two structures was to define different layers for each one of them. So the funds in which we should see some different portfolios. Each one of these portfolios would be defined by one class, and if you want, on the other hand, to congregate, a same portfolio for different investors, you should do it segregating subclasses in the same class. So that was, the macro structure. We just, draw from zero to propose to the market. And of course, this simplifies a lot how the market, investors, and even CVM understands the broader picture of investment fund, and of course allows the CVM itself to keep going with its supervision process and etc. So this was the big idea. I think the idea of subclasses, trying to keep in one structure a unique portfolio and segregate any other thing else, just like the target, the public target, or the management fees, or the redemption conditions, whatever, but all of these in the same portfolio. This is a structure that will be automatically or very quickly will be used by the market, I think, because we do have some many structures, local structures here in Brazil that in some sense already emulates this kind of structure. The master feeder structure, for instance, is a good example of that. So I think that there are some obvious and really very relevant gains or of scale and etc. using these new structures of subclasses, substituting the previous or the former master feeder structure. That's a good example, a very good example. But regarding the classes themselves, segregating portfolios inside a fund, we do have some concerns, not from the CVM side, to be frank, but coming from the market side itself, in terms of how other stakeholders would interpret it or would face this kind of structure, if the classes are really segregated in practical terms. For instance, how the judiciary bodies would face these new kinds of structures, and if they will, keep their decisions, take this possibility of segregating assets really in mind when deciding over. Let's think, for instance, if you have a fund with some judicial discussion and some counterparty asking for some resources from the fund, etc., how the judge would face this this class within a fund, besides other classes, and segregating different portfolios for these other classes. This judge will not fall in temptation in terms of I'll go after these other portfolios to satisfy what I'm demanding here in this one. So this is really a challenge, and we do not know how judiciary bodies or other regulatory bodies will face in practice this segregation of portfolios. But of course, as I mentioned, it's not something that's under control of CVM. CVM, of course, cannot control this kind of consequence. So I think we will have to try. That's the truth, and to follow up this, and to see how the market reacts and how all of these stakeholders will react to this innovation, and based on what or how they react, we think once again how to to improve something or how to change the approach. That's really a challenge, but it depends on the future. Sorry. So it's difficult to say now what kind of problems we will have in practice on a day-by-day basis with this innovation. But it's really a good question market has is being are making for us.
Very good, very good. And you talked about the subclasses that may be the future to replace the master feeders structure. All the market is already adapted to the master feeders structure, and maybe it will take some time for the fiduciaries and the managers to adapt and to do all the migration to the new model if it is approved by CVM. How long do you think it will take for the market to migrate to this new model?
Yeah, for sure it will take time, and not, you know, a relevant time. According to our last conversations with the market, we estimate something like, you know, we have two different concepts in our regulation. Any regulation deal with these two concepts. One concept is about, you know, when a new rule really become effective. And another different concept is not the same concept. Another different concept is, you know, a term, or, you know, a period in which our rule allows the market to be adapted to the new rules. So these are two. It's you know, the difference maybe, you know, look not so relevant, but the difference is relevant in practical terms, and these concepts are really different. So you know, said that, I would estimate, you know, for the rule to become effective, you know, a 6-month period or something like that, and the adaptation period, I would say, would be even longer. You know, once the rule becomes effective, we shall ensure something just like another 6 months or even a year. That's something that we are discussing with the market, but something like that, between 6 months or 1 year, to, you know, to allow the market to be adapted, in fact, to the new rule. So what's the difference between these two concepts? With taking this opportunity, you mentioned that the difference is about, you know, the flow of new fruit, of new funds, and you know, the funds that we have already registered with CVM and that are already running. When we talk about, you know, when the rules become effective, what we're trying to say is that, well, after the rules become effective, you only can launch a new fund under the new regulation. So that's the main point. But the adaptation period talks more, you know, with the funds that are already run. So this, you know, more than 20,000 investment funds we already have in Brazil running all day. These, you know, 20,000 investment funds, they will have a bigger period, an additional period after the rule becomes effective to really be adapted. So these, just as you mentioned, these structures, these master feeder structures that already exist, that are already running, they will have this additional period to, you know, to be adapted and to migrate to this new structure, you know, issued by the new rule. So that's I think, you know, in summary, the main difference between, you know, the date in which the run become effective, that's more targeted at, you know, the new funds, and this new additional adaptation period that will.
Thank you, it's very clear. And finally, CVM also proposed other changes, such as the creation of social and environmental FIDICs, credit rights investment funds. And we understand sustainability is very much top of mind for Brazil and other countries here in the region. So why has CVM suggested the creation of FIDICs with this label? And do you think it will apply also for the other types of funds, such as equity and fixed income funds?
Yeah, Ruth, you know, your question is really, really very good, because that's the question, you know, most of market participants have already done to us, to CVM. Why not, to expand, to consider this concept, not only for the FDICs, but also for all other kinds of investment funds here. And, I, frankly speaking, I agree with this, this consideration, this question, in fact, we do not have to limit our proposal to the FDICs, in my personal opinion. That's what I will defend. I will discuss internally before issuing the new rule. I think it makes total sense to expand this concept to any kind of investment fund, especially considering the approach we had in this proposal. As all of you may be aware, we didn't, we didn't define a rigid or a prescriptive standard to consider a fund as ESG or not. We didn't, define a taxonomy, for instance, or whatever. We made it more, more open, more principality, I would say, more principles based. So in this sense, in this scenario, I think it's even more, it's even easier for us to expand this concept, no problem at all. And, just like other markets are doing, just like the American one, or especially, I think it's a good example, a good inspiration for us, to supervise how after the rule, how the market are, defining an ESG product, how they are, establishing the parameters or the criteria. Eventually, just like happened in the United States, we may see here in Brazil as well a self-regulatory initiative in this sense. And based on this first and experiences in terms of products, we already have some products, more or less 190 or 100 investment funds, ESG based here in Brazil, but it's really a growing market. So we do expect this market to grow, a lot, still a lot. So based on these new experiences, after the rule, I think we will have, a more robust evidence, concrete and experimental evidence to give a step forward in our rule. Eventually, giving some more specific or prescriptive directions. I don't know. Well, nothing really defined or certain, but I do know, and I do agree that this concept should be expanded to any investment fund and not only limited to the FDICs. I agree with that.
Excellent, excellent. And you mentioned you have much interaction with the market. So I would ask you, are you receiving many feedbacks? I think the deadline is maybe tomorrow, or we're nearby the deadline. How are the feedbacks you are receiving? If you could talk a little bit.
Yeah, the deadline is tomorrow, you're right. And the level of contributions, in terms of size and in terms of complexity, are really, high. So some of the, of the contributions have more than 300 pages, for instance. So they are really, huge, and what's good for, of course, for our internal process. That's something that I was, I insisted in inviting the market to really contribute in this public hearing. In special, of course, we always invite the market to contribute as far as possible, and etc. But in this specific case, I think any contribution will be even more valuable, because even more important, because many of the issues in there are new including for CVM. If you think about it, you know, the limited liability of investors or the classes of quotas, these kind of things were never discussed by CVM because the law didn't allow this kind of thing. So that was not possible for us, for CVM, to discuss classes of quotas with, you know, segregated portfolios or limited liability for investors, because we didn't have, you know, a proper room granted by the law in that sense. So now that we do have this room to discuss these issues, of course, these issues are brandly new for us, including for CVM. So the experience from the market, what are the demands, the real demands from the market in terms of, well, what I intend to do with the classes, or what I intend to do with the limited liability. All of these are really very important inputs for us for the discussion. Because that's it. We do not have a regulatory or even a supervisory experience in these fields. So I do hope the market contribute a lot, and the first contributions that came to us were really very good and productive and, you know, thoughtful. This can help us to make our best decisions in these issues.
Thank you. Very good. And so, since we are almost out of time, would you have some final remarks that you would like to share with us?
Yeah, Ruth. I think not. I think I speak a bit here about some of the main issues in discussion at CVM. We intend to issue this rule by the end of this year. Well, once again, it's another challenge for us. And the public hearing process is really, you know, complex and big, and, you know, many issues coming from market demands, the Food and Economic Law, supervisory demands as well, international demands. We had some recommendations from international forums, just like FSP and IMF and World Bank and etc., regarding some issues here in our regulation. And we are trying to address that in our proposal. So, you know, there is a mix of many different aspects for discussion in this rule, but we really want to try to issue something this year, because we do know and we recognize the importance of this rule for the Brazilian market, and as you know, a drive for growth in our local investment fund industry. So I'm very glad to have this discussion. I always joke with people in the sense that, you know, we have now in hands a good problem, you know, how to make the industry grow even more and faster. So that's the good discussion for us to have always. And once again, to thank you, Ruth, and Melvin and CFA as a whole for this chance to, you know, expose a little bit about what we are discussing there. And once again, always at disposal for any further discussions. Thank you.
Thank you, Daniel. It has been a real pleasure. We appreciate all of your insights, and we look forward to having you again. And I would like to thank Melvin also, as well as Inigo and all the team.
Very good. Bye-bye.
Bye. Thank you.
Thank you, Ruth, and thank you, Mr. Maeda, for the keynote speech. I'm Inigo Benguechea, CFA, and I'm the Senior Director for Government Relations at CFA Institute. I am delighted now to present the moderator for our next panel, Ana Carolina Lima Nomura, who is partner for the law firm of Mattos Filho in Brazil. Ana Carolina specializes in national and international transactions involving investment funds. She has experience in private equity, securitization, and structured finance transactions. She also advises clients on the structuring, fundraising, negotiation, and formalization of investments, as well as the acquisition and disposal of assets. She worked as a foreign lawyer at Simpson, Thatcher, and Bartlett in the United States, and Ana has a law degree from the University of Sao Paulo. Welcome, Ana. I pass it over to you.
Hello, Inigo. Good afternoon, everybody. Thank you very much for the invitation. I'm very pleased to be here. It's great, to have a panel after the regulator because we can get many insights. But before we get there, I want our panelists to introduce themselves. I have Daniel Celano and Marcos Goncalves. Daniel, could you start introducing yourself, maybe?
Hi. Well, can you hear me? Hi. Okay. So I'm Daniel Celano, the country head of Brazil with Schroders, and I'm also CFA board member. So it's a pleasure to be here and be part of this panel with Carolina and Marcos, sure.
Marcos?
Hi guys, good afternoon. Thank you for the invitation. It's a pleasure to be here with Ana Carolina and Daniel. I'm Marcos Vinicius Goncalves. I've been with a company called Franklin Templeton here in Brazil for 20 years. I'm also a CFA charter holder, and I get a background in law and economics here from the University of São Paulo as well. So glad to be here.
Okay, great. Thank you both for participating. There is no doubt that the proposed new rule to regulate the entire investment industry in Brazil represents a very bold step in the development and continuous growth of our industry. It does not only propose to implement changes to, adapt the rules to the innovations of the law of economic freedom, but it reflects a full review of our entire regulatory framework. And the idea, very well, expressed by Daniel, is to modernize our industry, to sophisticate our products, and take us to, to take us closer to our international peers. And this move, it's very important, especially in the current scenario of low interest rates globally and historically lowers in Brazil. Our industry has grown a lot during the past 2 or 3 years, incentivized not only by the lowest interest rates, but also a very active capital markets and the distribution of funds through platforms. And the industry has been playing a very important role in our economy in general. Not only allowing investors to diversify and to have access to, different and more sophisticated investment products, but also as an important source of finance or credit to companies and to the real economy in general. I'll take this very specific point about, the access of investors to different and more sophisticated products to start our discussion on a matter that Daniel commented a little bit, with the proposed change that allow retail investors to access local funds that invest 100% in assets offshore. So based on this proposal, retail investors in Brazil can have now more options, more sophisticated options, and more access to international players and international products. I want Marcos and Daniel maybe comment a little bit from the manager's perspective, and they've been maybe discussing this matter a lot. This is a very old proposal and request from the industry. Maybe you can share your side of this innovation, the demands that are out there, and the opportunities for the investors and for the industry.
Sure.
I don't know.
Marcus, I will start with the background that you're very familiar with as well, and I will lead to you to give up your comments on the basic proposition that's there on the public hearing and your views about that. But just coming back like 2 steps on that specific question, what we have seen is that there was a debate about Brazilians being able to let's say, have international investments as a diversification factor and things like that, right? And in the past, in 2015, if not mistaken, the legislation has changed in such a way that instead of sending the money overseas, the Brazilians could have access to international investments in different asset classes in Brazil without sending the money overseas. So basically, it was good for everyone, I think, because it created the industry in Brazil, and with local players, with local custodians, with some sort of safety net for the regulator as well, because there's you saw from Maeda's comments that they are always willing to do that, kind of make it more flexible, but at the same time with the mitigation factors and make it safe for investors. So I think that was a big progress in 2015 about that, but it was suited mainly to qualified investors, right? And then since then we see like a lot of what he called like mirror funds, but we also call feeder funds. It's kind of the same concept, but having a local fund in Brazil that has a local custodian, a local asset manager that are duly authorized by the regulators and the whole the framework of the regulatory rules and doings, and then invest like a local fund and invest overseas, right? But then we see that there's a lot of need for international diversification, not just for purely international companies to the Brazilian investors, but also to institutional clients, and also to retail clients, and in some shape or form, even some local managers, including very likely us and some other market participants, have started to have access to international assets and securities using kind of limits of 20 or 40% anyway. And for you to go to 40 to 100% internationally, you would need some sort of extra layers of protection for the local investors, which means relying on a regulator overseas with other things. And I think that the point is here is pretty much related to how you make it flexible, but at the same time, you don't open the door for something that's uncontrollable with lower visibility that makes the regulator kind of very, very uncomfortable with. And eventually the clients with no transparency and knowledge at all to make the step further. So at the same time, you need to fulfill these 2 different gaps. Like you want to have more access to make a more efficient portfolio allocation anyway, but you need to fulfill these 2 points. Like investors need to understand what they're going for, what they're investing in with more knowledge, and the regulator needs to be considering that they are safe enough for this to be open. So I think that we are in the verge to have second wave of making it more flexible, but again, coming to the point that it needs to be secure from a regulator's perspective. But on the other hand, just to finish my comment and pass on to Marcus, is like you said, Carolina, about the lower environment in terms of interest rates. It's true globally, and in Brazil, people may say, okay, but coming back to 4 or 5, but it doesn't really matter because the real rates are going to continue to be very, very muted or even negative in the short run. So this international need for diversification in different asset classes is going to continue. And I think that we're going for the second wave where general investors will also have the same sort of, let's say, access with some other mitigation factors that I think that the public hearing put together for the market to discuss, which I believe that has a huge chance to be approved and put forward in the future. So Marcus, please feel free to jump in on that one.
Okay, yeah, no, so, I totally agree with your comments, and I'll just complement with one thing, and this being a Latin American event, I think it's important that, people always have this question about, I mean, why is Brazil so different than other regions? I mean, clearly the difference is what Ana Carolina said. We have a pre-developed local market, and this was built based on our specificities, right? So fortunately and unfortunately, our market has been growing in a very tortuous way, in a very unique way. So in Brazil, as some of you are familiar with, we call, you know, our uniqueness jabuticaba, which is a local fruit, and we like to create our own things. But we are not, you know, different than Latin America in two aspects. One is the, you know, the history of inflation, capital controls, and financial repression. And the second is the way the law is written and the way we like to have everything, you know, in writing, you know, on the paper, all the details, the articles, and you know, the lineas and this and that. So the whole thing is, I'd like to start by praising Daniel Maeda. So it's good to be speaking after him because he's always been very open and very candid and very frank about what can and cannot be done. But he's always been aware of the need for Brazil to get more integrated. And I think Brazil has always been very insulated. So we always, you know, we always saw our own world because we didn't need, I mean, people didn't see the need to diversify away from Brazil because rates were high, you know, and they felt that there was a huge home bias. I mean, every country has a home bias, but Brazil was probably much bigger than average. And I think what's happening probably since, as he mentioned 2007, but I'd say 2015 was the first, you know, major move, which was the current instruction that we have, the 555. And now this new one, which is probably another revolution because he's bringing, as he mentioned, new concepts that basically make us more aligned with, you know, the best practices of what's being done abroad. And of course, makes Brazil also more, you know, let's say the communication between Brazil and the other OECD countries, I think makes it much easier. The challenges always, I'd say are two are, you know, we have many, but two are very clear to me. One is the fact that, I mean, there's the market is not used to that. So think about that. We have more than 600 asset management companies in Brazil. And the clients are very used to handling that, but I mean, it's very confusing today with local managers. So now on top of those, they're going to also have an offering of global investments, and they have never heard about that. So it's going to be something quite new. So there's got a lot of education that needs to be provided, you know, a very steep way of doing that. And I say that the other thing that Maeda also alluded to that is very, you know, it's very clear when we discuss this. We have been discussing in different forums here with the industry about, you know, the proposals to the public hearing. And I mean, the phrase that comes to mind is it's very hard to, you know, teach new tricks to old dogs. I mean, the industry is comprised by very old dogs who are very used to old practices and they don't like to change. So we need our peers, we need to make sure that, you know, they abide by the changes, they sponsor the changes, they embrace the changes. I think that's something that the CFA Society in Brazil and the CFA Institute overall has been very, you know, has been trying to do, you know, to help the market embrace those changes that we see are for the better.
And it is great to hear that, Marcos, and it's very aligned to what Maeda just told us, is that CVM is opening its mind to alternatives and to, you know, investments offshore. At the end of the day, I do believe this is a matter of, you know, picking the right manager. Like doing your due diligence, and it really relates to, you know, investors' education, because the fact that the asset is offshore doesn't mean anything in respect to risks and quality of the asset. So you could have like local assets that are terrible, that are very risky to the investors, and very, very high quality international assets. So it's a matter of, you know, choosing the right manager, having, you know, enough information disclosed to the investors, and accountability, of course, like that the regulator is here for that. So I don't know, I'm very optimistic, and I do expect that this new change is going to open doors and allow our industry to grow even more, and bring new players to increase competition, which is very, very good for our own industry. So going to the second point that Maeda also mentioned, the possibility of funds to be formed with different classes of quotas, each representing an absolutely segregated portfolio. So different assets, different risk, different exposures. And of course, the current language of the rule is still provides certain limitations to the differentiation between the classes. Some of them are very important, and maybe we share common concern about them. And the public hearing is important because we have the opportunity to share our views, our market views, and our legal views as well. Hearing Maeda saying, it seems that he's a little bit concerned about, the judicial view about this potential discussions around the classes. But this is a good opportunity for us to share our views with the regulator. I do believe that this is a very bold and important change to our market. It takes us to, closer to international standards, and in time, it might be a very, very important tool for the development and sophistication of our industry. I want to hear your opinion as well, and maybe we can start with Marcos this time.
Yeah. No, so this is something that we have been talking to the regulator for a while, to the whole industry. So the ability of setting up, classes, subclasses, it's something that we brought to the table. And the irony, as I mentioned, that the industry is very, recalcitrant and they resist to change, is that when he put it, together and showed to the market was, the first thing that we heard was, it's never going to work. It's never going to, this is going to be like something dead by arrival. So we need to explain the benefits of that. And I think, so going back to the competition. So it's funny that there's a lot of competition on the asset management side. So we have a lot of, players in the market on that side. On the distribution, as probably some of the locals here know, but probably the foreigners, would benefit. We are in the middle of a big disruption going on in the market right now. So you have on the distribution side several independent players. The first one, of course, is XP, the famous firm now, a multi-billion-dollar firm, and they are basically building more competition on the distribution side. So the banks who had captive distribution and didn't see the need to have an open architecture and to basically show third parties to their clients, or even to the differentiation of the fees or the transparency of the fees, that was something that was not discussed. And XP and the followers, all the other platforms. So no, all of them are great. So we have no preference. All of those platforms are great, but I think they're bringing change, and that change is good. The discussion about the classes, subclasses, I think has that benefit of creating, for instance, something that in the US and in Europe is very common, which is the exchangeability. So you can exchange funds, you can exchange, within the fund families, or even you can change your distribution. I mean, I have the same fund that I buy on bank, ABC, I want to go on bank XYZ, and that's very, very easy to do in other countries. In Brazil, on the retirement side, that's something quite easy to, what we call portabilidade in Brazil. It's something quite common and has actually been responsible for the growth of that industry. That's an industry that grows, of course, also related to taxes. They have preferential treatment on taxes, but that's a benefit. So the portabilidade is something that's been very, very good. And I think that the whole discussion about classes and subclasses brings that to the table too. So we can eventually differentiate the subclasses by fees. We can get rid of this master feeder structure that he mentioned. The people are very attached to that, to those master feeders. And then what happens with the master feeder is that you have an industry in Brazil with 22,000 funds. I mean, 22,000 funds is ridiculous. You don't need that. You can have much less than that. So you sell one strategy, and that strategy can have subclasses. But you don't need to have 22,000 funds because you don't have 22,000 strategies. So that's one thing. The other topic is governance, but then I think I'll let Celano comment on governance. But just to give a glimpse of what we have been discussing. The whole discussion about governance has to do with the fact that in Brazil, funds are they are owned by the shareholders, unlike in other places when they have corporate structure. And this suggestion makes a few changes to that and may make governance a little more in sync with what we have abroad. But I'll let Celano comment on that.
Okay, thank you, Marcus. You let the easy part from you, sure.
Always.
Always. Just one comment before I jump into that one. Actually, two comments for the audience that don't really got what the public here is talking about in international investment changes to general investors. Pretty much giving a little bit more of access to well-regulated jurisdictions with extra mitigation factors like concentration limits and also enforcement by the regulator. So it's exactly what we have for qualified investors with extra layers of protection to be extended to general investors. So I think I'll have very good chances surrounding like concentration issues and controls in terms of counterparties and things like that. So this is one thing that we discussed. You mentioned the portability, right? The money to be portable in the retirement industry. And in Brazil, we say that we have a Brazilian 401k, which is pretty much not a 401k per se, because you have an insurance company as a wrapper between the plan participant and the invested fund that has this kind of a retirement nature. The funny thing is that, yes, the portability for insurance companies on this Brazilian 401k jabuticaba it's well placed because it started like long ago. However, the regulators are different ones, not the Brazilian Securities Commission, and they still ask you to sign off manually when you need to change anything. So it's a lot of idiosyncrasies in the Brazilian market, and unfortunately, we don't have this kind of let's say streamline or like a more common denominator regulation from the different regulators we have. But coming to the point of the share classes, I think that the major challenge is like if you change. No, I say that this public hearing, especially on this matter specifically, is changing the chassis of the car for a train or something, or all the way around. They're not comparable, right? The things that we did in the previous regulation, when you go for this one, when you have share classes, limited responsibility type of funds and things like that, makes such a big difference. So, and human beings, they do live about analogies, right? What's comparable to what, right? And this one is like resetting. You need to think differently. So in order to think differently, you need to think that, okay, the share classes will come. So instead of saying funds, you're going to say share classes, right? Or subclasses or whatever we call. But then you need to make a distinguishment very clear what is limited responsibility, which means that the shareholders, the clients are not going to be asked to put money. This is one thing, and illimited responsibility, which they may have capital calls. So once you do this distinguishment, that needs to be very clear from the beginning. The way you set up the funds and the strategies and the classes and eventually subclasses, they are going to reflect different profiles, minimum subscriptions, different fees, different access. Is going to take place if the market really understands the benefit. And we have seen that the benefit for some structured products, like the structures we have in Brazil that resembles like asset-based securities or market-based securities in US, that you have PGICs or you have something like that, or the structure like PIFs, which is a kind of private equity in Brazil type of arrangement. It's already common to that structures to have this sort of different share classes and governance or difference as well. But for equities, fixed income, plain vanilla credit, kind of speaking, and a few others in the local regulator hedge funds that we call Mercados, they are not the same. So in order for the market to embrace this one, the benefit needs to be clear. And I think that the major challenge coming, to Maeda's point, and I think that CVM, Brazilian Securities Commission, will have a very big challenge, is if they replicate all, the rules and the balance sheet, the audit costs, and all these kind of costs, and let's say the observance of this rule is going to become very costly. So you're going to pretty much change from master feeder to share classes. So, and then the market say, why should I bother doing that? Because at the end of the day, I'm going to have kind of the same with different fashion. But the thing is the following: if you have this basic distinguishment between what is limited responsibility, what's not, and you may have the share classes as a tool to embrace, to tackle the clients, and coming to the distribution point that Marcus said about the disruption that's coming from new distributors coming. I think that the governance might be a big change there, because if you have a better governance, because nowadays, and just to sum it up, like nowadays you have a fund that you have a kind of fiduciary administrator that's kind of the landlord of the sheriff of fund, and then you have the asset managers doing everything, and then you have the shareholders that are not in clients that not necessarily know in a full extent of what's happening there, because it's like a doctor that's not being called for a emergency, and then you call a lawyer and say, should we operate or not? The lawyer's not going to know, right? It's a doctor issue, it's not a lawyer issue. So I think that sometimes you have a lot of information asymmetries that the governance that we are trying to put together with some sort of a board structure would be on the benefit of the clients, which means when you have some of the things that are not really clear, again, among the fiduciary administrator or the asset manager, right, the portfolio manager, you may have like some independent board there to form in the benefit on behalf of the clients, because we have a lot of asymmetries, right? So if you're going to get a medicine, why should I, the only thing you can do is ask for a second opinion, but you're not a doctor. So nowadays you ask sometimes the clients to go there and vote for something that they don't understand, right? So someone needs to be there on their benefit. So I think that the share classes and can help on that. And also, again, depending on how these kind of extra layers of things will fall apart in different structure, and the governance might be a very good thing for clients at the end of the day, even though we don't have a corporate structure as we have overseas, but it's somewhat emulating that. So I think it can be a progress if it's fully embraced, and let's say the hurdles to go from master feeders to share classes are not big enough for the industry to move.
Yeah, I totally agree. Of course, there are certain improvements to be made to the current draft, but I totally agree with both of you. We should embrace this. And Celano, you raised a very good point. We have been, of course, working in this industry for long, and we do work with private equities and receivable funds a lot. And I remember when the share classes was not obvious in the private equity rule, and once the rule changed, everybody was very skeptical about it. So nobody's going to use this instrument. And of course, it's a little bit different. We are not talking about segregation of portfolio. We are just talking about what in the new regulation is supposed to be subclasses. But at the time, everybody was very skeptical. The administrators were arguing that they could not adapt their systems to, to receive that or to operate like that. But now this is a very, very common structure. So I do believe that in a certain period of time, we're going to be using this share classes a lot. And I believe it has like a very important role in two things that both of you mentioned at a certain point. Transparency, which is very important in the scenario that we are living now with the roles of the platforms and the mass distribution of the investment funds, which takes me to maybe our third point of discussion, which is the new proposal in respect to disclosure of fees. CVM, we know that CVM is very, very concerned about quality of information. That Daniel Maeda, personally, I have heard him saying that he's not concerned about like a great amount of information, but he's looking for quality of information. And in 2014-15, when 555 was issued, I believe it was like the initial breakthrough in respect to this matter, when CVM asked all players to, either cease the practice called rebate or to disclose the fees. And now the new rule again require more transparency in respect to that. So I know, Celano, Marcos, do you want to comment a little bit about this as well?
Yes, I think on the terms of this, transparency is the key value for CFA Institute. So and of course, like more competition in the benefit of the client, right? We are pretty much client-centric on this matter. And I think that the issue is not necessarily on the transparency. I think it's how you disclose the transparency, right? Because at the end of the day, the following thing might happen. You have a lot of transparency, but it becomes like you you're buying a medicine again with a lot of, small letters, and you don't really get it. It's like the quality of information needs to be good, but also how you deliver that, right? And if it becomes something like when you go for these topics, it's like you get like 15 pages to understand where you're in. That's going to be valuable anyway. So my point is, the conflicts of interest, even by CFA Institute standards, needs to be disclosed right away. So you need to say, I'm doing something for you, and I get a service. I'm gonna say, Carolina is kind of referring you to do something for you. So I think that we are very clear about that. The issue is how you're going to deliver that information. And the other way around is like, you shouldn't go for certain, agreements. They're kind of private, to go for anyone in the market, right? That has nothing to do with that specific topic. So you need to serve the client. So my view and coming to that point is like going to the end client on his benefit, right? So on his benefit, he needs to know, is there any conflict of interest there, and the nature of the conflict of interest. So it needs to be like a distribution policy at the end of the day. Just starting with, like, you go there, what's the distribution policy? What I offer you, why I offer you, what my selection process, what kind of the rebates or distribution fees I charge from you, like transparency, right? You may leave and do elsewhere, but you need to know it starts with, because at the end of the day, the asset management industry, and it's a trust. Either you trust or you don't trust, and you have a business or you don't. Because a long-term business is a people business, and you're kind of people are trusting you with their assets and their savings, their wealth. So it doesn't really matter. It needs to be based on real transparency. So I think that the major challenge here is pretty much how you're going to deliver that. I think that there's going to be a lot of pushback of not disclosing anything, which I don't think it's, I don't think it's the good way of doing that. I don't think that's a good route. I don't think that CVM is going to rely on that. They are going to pretty much push back as well. But I think that, on the other hand, disclosing everything for everything might be not, let's say, useful or even suitable, right? It's something that doesn't fit to purpose. So I think it needs to fit to purpose, and fit to purpose needs to be like, a client knows what they're buying, how much they're paying, if there's any conflict, and if the conflicts are there, how much the guy that's kind of offering that is getting the money from. So the client's not played, right? It's not, I'm going to a doctor and then they get commissions because they are, giving one medicine rather than the other. They need to think what's better for me, right? It's the same concept. So I think we'll have a lot of challenges on this one because there's no consensus here, for sure not. But of course, being where we are is not enough. Disclosing everything for everybody on 15 pages is not going to be useful and fit for purpose anyway. So the middle ground here might be something that, suiting, the issue where it stands with the client and how the client is going to be serviced in a trustworthy relationship. Marcus. Yeah.
No, so I'll approach this in a way to explain again the uniqueness of Brazil in many regards. So I spoke before about the unbundling, right? So we are specializing more and more compared to what we had before, when you had like a one stop and shop. So people used to buy their investments at the same place where they used to buy their credit cards and whatever else. And now, as you have more different vendors and different providers in a product, the transparency makes it clear not only how much you're paying, but what are you paying for. So what is everyone doing? So Celano mentioned another great example that we like to use as something that sometimes doesn't make sense, which is what's the role of the insurance company on a retirement plan in Brazil? I mean, it sounds obvious when you ask that, but when you go to the specifics, it's kind of funny. I mean, for us who are on the day-to-day business and you're negotiating agreements, sometimes if you look at some of those plans, the insurance company shows up as a co-manager, as a co-portfolio manager. I mean, they have zero portfolio management responsibility, zero, but they're listed as co-portfolio manager. On other instances, they're listed as consultants. I mean, they're not consultants. They don't do any consulting, especially on the investment side. So we are trying. So one thing that is funny is that, I mean, the insurance company is there. they need to be there because it's a plan. It's not a fund. But the products are sold as investment funds. So they're being missold. And as you make it clear, and as CVM, rightly so, is asking for more transparency, it becomes more clear that, what is the distributor doing? What is the administrator doing? What the administrator is not example. So as we were saying, I mean, he's the intermediary of everything. He's the guy. How do they call in the US? They call he's the quarterback. So he's going to be the quarterback. He's going to be coordinating the whole thing. But I mean, what's the point here? He's taking responsibility, but is he really doing more than just fund administration? Is he doing portfolio management? So that's the thing. The whole thing about transparency is to make it more clear who's doing what. And for the investors, I think that's a huge benefit. The second point that I'd like to touch is the differentiation that I think in other countries, it's not a problem to say, listen, economies of scale, this is a business of scale. So if you have a large ticket, if you're a private banking client, sometimes I can offer you a cheaper product because you're a private banking client, so you bring me more volume. In Brazil, sometimes this feels like, prejudice, because you have to offer everything to everyone at the same price. Makes no sense. So that's the story about having different subclasses, right? So you have the retail subclass, you have the institutional subclass, and in Brazil, sometimes you feel that, no, we cannot have that. So that's why you create this master fee structure, and then you create layers of fees. And, if you're not a specialist, if you're not a market practitioner, you won't be able to realize how much you end up paying. And the other thing that I think, the last point that I'm going to make on this, and for as funny as it sounds, the mutual fund industry is way more transparent today than others. So we always complain about, an asymmetric approach, and I think we have a good point, because some other products like COIs in Brazil, the structured notes, they're even worse. It's even worse. People, sometimes they have no clue how much they're paying. And that's something that needs to be, taken care by the regulator. But I think, the whole discussion of transparency of, the breakdown of fees, I think it's, it's long due.
Great. We could be talking about this like in the entire afternoon, but we need to wrap up. So I'll bring the last topic and we can talk about it very quickly. Maeda and Ruth talk a little bit about sustainability and ESG orientation for the investments and the investment funds. And Maeda was very vocal in accepting the recommendation or suggestions from the market to have this type of approach or this type of label to the entire industry, not only to the FIDIC. So we might expect this to come to to be applicable to the funds in general, to the general portion of the rule. But he also mentioned that the approach is very based on principles, that CVM is not necessarily ready to have, specific parameters or standards or like a more more described type of approach. So which is a good thing on one side, and may have this challenge to the other side, to the extent that sometimes it's more difficult to compare funds that have the same approach. So Chair, please share with us your views in respect to ESG matters and sustainability for investment funds in Brazil.
Yeah, I think I'm also part of the consultative committee at BYMA, the Regulatory and Trade Association in Brazil. I cannot speak on behalf of them, but we have been working very hard there. So I think that a lot of good is going to come from this debate and working group in BYMA, and the people there are doing a great job in terms of benchmarking, getting information from. So I think that we're trying not to reinvent the wheel, but at the same time trying to make a, let's say, a framework that you can compare apples to apples. So I think good things will come this year about that specific topic. And I think that this, of course, is going to be shared, it's already being shared with the Brazilian Fiscal Commission anyway. But it's not it's an easy topic, right? So it's not like, okay, you have a clear cut, go for it. This is your, book one, do it, and that's fine. It's not the way it's gonna work, right? So, but what we have seen is like, there's some sort of, let's say, inspiration on what we call Articles 8 and Article 9 in Europe, right? So you have kind of sustainability finance disclosure requirements, which was SFDR. So you have to set a bunch of rules and to fulfill a lot of things in order to be able to promote, let's say, a sustainable product. So it started like long ago with some sort of a sustainable, I took notes here just that don't miss it, sustainable finance action plan that you need to have standards to integrate, taxonomy. So the taxonomy is like how you compare things, right? When you go to buy a car, how you can compare like a sports car and a kind of SUV, you have like this a taxonomy, so you understand that. So I think like before, I will probably leave the articles 8 and 9 to Marcos to go about it, but the type of information you need to keep in mind in order to do that, which the Europe and the developed markets, especially Europe, is pretty much developed. Like they have pretty much 3 different factors that you need to take into account. The first one is like, okay, ESG, what's the sustainability risk to the investment? So when you're buying a sustainable product, you also want some investment in risk parameters. So by the time that you buy the sustainable product, what are the risks to the investments that might occur? So this is the first vector. The second one is like, what is the investment risk to sustainability? So if you're saying that you're a sustainable fund, what kind of risk you can impose to the ESG agenda if you do so, right? Like a principal agent conflict. So if you're buying some sustainable, and what's the risks to your investment? And if you're buying, if you're doing some sustainable, what's the kind of risks, right, to sustainability if you're buying things that are not aligned to that? And then you go to promote the funds, like market the funds, either mainly Article 8 or Article 9, in which Article 8 is pretty much if you are, if you're kind of selling a product with a sustainability type of approach, integration, you have some sort of filters and so on, then you have some sustainability there. And Article 9 is pretty much, you want to deliver alpha or returns or whatever, but you also have a goal, an outcome on sustainability. So it's like, the Article 9 is pretty much like a climate change fund or something that's really an impact that you may measure, that's going to deliver you returns, has an outcome related to ESG. And the Article 8 is pretty much some fund that has a sustainability aspect there in the investment portfolio, in the portfolio making decision, and so on and so forth, but it's not with a goal in terms of sustainability. And this is pretty much what the market is discussing at this time. So what's going to be called ESG, what's not to be called ESG, and ultimately speaking, just to finish my comment, is like, we will want everybody to be like Article 8, right? So pretty much like the whole market's going to see like in a different lens, like risk, returns, and ESG kind of. Before you just were considering about getting returns, and then afterwards like getting returns at which risk you're talking about. So risk like the cost of the the returns you want to have, and then you have the ESG lens, which means you're going to have this approach of a third dimension to your portfolio, to investments like risk, return, ESG topics that needs to be considered there in order for you very likely to select the best investments and also to mitigate some tail risks, right? So I think that the industry is going that direction, but I would like Marcos to comment on the other topics about this specific one.
I think you covered pretty much. I mean, I'll just try to summarize in 2 things that you mentioned. I think that are quite important. One is the terminology, the taxonomy, as you like to call that. I think, it's a challenge everywhere, right? So we have different terms for different things, and even the CFA. So I'll do some self-promotion for the CFA Institute here. Probably the best sources of information on that topic are on the CFA website, and all the all the papers, so please please look for that, because they have even the history of that. So we used to call socially responsible, then we started to call sustainable. So of course the challenge there are, the challenges are 2, I think. One is people trying to hide behind some new term, and then leading to the second one, which is greenwashing, that I think most of us are always very concerned. They are very vocal members of this this group of the Society of the Institute. Even in Brazil, I mean, two come to mind, Fabio Perovic and Mauro Cunha, those guys who have done a lot for ESG. And I think they're very right in saying that, we should have codes and we should have enforcement. I think one very clear point, I mean, and Schroders and Franklin and Mattos Filho and our firms, they are all, signatories of most of those. And I think the key thing here is to make sure there is some enforcement. So that's one of the topics that it cannot be only like, best practices. It has somehow to have some sort of enforcement. Otherwise, people are going to do greenwashing, unfortunately. But I think Celano is totally right. I mean, that's the way to go. And SFDR is making us, especially in Europe, they're burning the bridge, so to speak. So there's no way back. And that's good. And I think that's good. And we see the same here. We see our clients, dramatically more inclined to ask about that. And that's going to be like in 10 years, I don't think even we're going to be having the conversation about the integration. It's going to be a done deal.
Great. Thank you very much, both of you, Marcos and Celano. It's great to be talking to you. As I mentioned, we could be talking about this industry issues for entire afternoon, but our time is up. So thank you very much for your contributions. Thank you very much, CFA Institute, for inviting us, and have a great afternoon.
Thank you.
Thank you.
Thank you, everybody. That was a great panel. Thank you, Daniel, Marcos, and Ana. And now we proceed to the next panel. I give the floor to Sofia Ordóñez, who is an analyst at BTG Pactual. And Sofia, please go ahead with the next interview. Thank you.
Okay, hi, thank you very much for having me here today to moderate, and thank you very much to our speaker, Alejandro Garnet, for taking the time to talk to us today. Well, it's been quite a year for Argentina this past year. We've faced, like every other country, we've faced the pandemic. We've faced debt renegotiation, and we've also faced a lot of changes in terms of regulation. And for that, we have today here Alejandro Garnet, who is going to share his thoughts and his experiences with us. And before going on, let me just read a short introduction on Alejandro. He joined Caja de Valores as CEO in 2014, and he has served as CEO of BYMA since 2017. He has wide experience in the financial sector, both domestically and abroad. He holds a degree in industrial engineer from the University of Buenos Aires, and he also holds an MBA from University of SEMA. Hi, Alejandro, and thank you for being here today.
Thank you, Sofia. Thank you, Inigo, and thank you, CFA Society, for this invitation. Very happy to be here to tell you how we experienced the last year, which unfortunately it's been just another hectic year for Argentina. It's not the first one, and let's see how it continues going forward.
Okay, so Alejandro, on that note, the first question I have for you is a very general question to start off, and it's relating to the challenges and opportunities that you've had BYMA has had this year with the COVID pandemic, and particularly how do you see if the demutualization of the company some years ago, if that has been helping or hindering you in facing those challenges that this past year?
Yes, thanks, Sofia. Definitely, for those that don't know, Argentina began a demutualization process in 2013. At that time, a law was introduced obliging all the exchanges to demutualize, something that in most countries happened way before that. So it was a little bit in overdue that we should demutualize. So the process for us really began in 2016. There was a transition period. So BYMA was created in 2016, And maybe some of you remember the previous name of BYMA, which was Merval, Mercado de Valores de Buenos Aires. BYMA stands for Bolsas y Mercados Argentinos, and it's a result of a spin-off of Merval and an asset or reorganization because BYMA became the sole owner of Caja Valores, the Central Securities Depository. So that happened between 2013 and 2016. And as to your question, I think it was definitely a good thing because the previous years up to that, really there was very little investment in infrastructure and modernizing the infrastructure of Argentina. So in 2016, as we began the new exchange, we also started investing heavily in changing all of our core systems. We now run, for example, on the trading side, we run the London Stock Exchange's trading system, LSE's trading system, which is from a company called Millennium. And that obviously increased by 400 times the amount of transactions per second we could process. So that was very important because when the pandemic hit last year, obviously there was extreme volatility. And that coincided also with the appearance of algorithmic traders. So now Argentina has quite a high number of algo traders because the technology has become so cheap that there's a lot of different robots and algo models that some brokers have bought, other brokers are even renting. So there's a rent robot business. But for us, it's meant that we saw our volumes double in dollars last year and triple in pesos. So it was quite a significant amount of growth, especially when you consider that the foreign investors were absolutely absent from the local stock exchange, right? If we remember in 2019, as the government changed, a lot of foreign investors left Argentina. And so last year, all of that volume really was from the local investors. So having invested clearly allowed us to be ready for that. And it was also not only the investments that we did, but also the new products that we introduced. So for example, we introduced Market Maker for CDRs. CDRs are like the BDRs in Brazil, the inverse of an American depository receipt, where you have the receipt locally and you have the underlying share abroad. So CDRs really took off. They used to be 3% of daily turnover 3 years ago, 2 years ago. And now they are 2/3 of the volume. So now they are much higher than the local shares. And that was because a lot of local investors saw the opportunity to dollarize their portfolio and to arbitrage. So it created a lot of new business for the local brokers and interest from the local investors. So that turned out to be an interesting change in the local market. Another thing that happened last year, also related to the new government and the new FX restrictions locally, was the significant growth in trading of local debt, the obligaciones negociables. That debt increased 9 times in the secondary market. So the volume increase was really significant. And on the one side, it had to do with more issuance by the corporations, because the central bank restricted the access to the official FX market, which meant that companies that had to repay loans and debt, they had to restructure their debt and they had to raise new capital, and the only option was locally. And that was going on at the same time as the sovereign debt renegotiation that you mentioned, Sophia. So clearly there were a lot of things going on. It was really a lot of nervousness also for investors. But all in all, we saw that most companies were able to go through. Some, like YPF, they tried to renegotiate or restructure more all of their debt, but they could only do the short-term part. So they still have some pending things to restructure in the future. Because as we see, these FX restrictions will continue for some time. We were hoping that the government was going to renegotiate with the IMF before October, but that doesn't seem to be the case now. So this nervousness will probably continue, as will the closed FX market. So in summary, we saw a year that was a significant change. There were a lot of restrictions. It was very difficult for the issuers, but from the exchange perspective, we saw a lot of growth last year as a result of the new investments and the new products we had launched in the last couple of years.
Thanks, Alejandro, very clear. Another question I have is, I wanted to discuss a little now about ESG, and in particular, can we discuss the innovations that have been made by BYMA in terms of corporate governance?
Yes, from the very day that we started as a company, we felt that higher corporate governance was very important for the market. We learned a lot from B3. We have a close working relationship with them, and they were kind enough to tell us about the Novo Mercado and how they built it and what things they would change. So we placed a lot of, we learned a lot from them and placed that history that into the launching of our panel. We launched our panel of higher corporate governance standards in 2018. It took us a little bit more because we wanted BYMA to be part of that launch, because again, we truly believe that higher corporate governance standards is very important to develop the local capital market. So we had to change some things internally, new policies, new committees, different board and so forth, have independent directors. So when we changed all that, we launched in 2018, as I was saying, the higher corporate governance panel. It really consists of two panels. One is called GC Plus and the other one GC. And that's because in Argentina, banks still have multiple share class or shares with more than one vote as different classes. So if we were going to be so strict, it would leave out a lot of companies from being able to come into the higher corporate governance standard. So we launched both, and the only difference is really that one. In Plus GC, it's all one share, one vote, and in GC, as we call the panel, that one is for companies that have different share classes. When we launched in 2018, there were three companies when we launched. It was BYMA and two others. And now we have 5, and we're seeing that there's more interest from companies in spite of the situation, in spite of the difficulties from a macro perspective in the country. There's still interest for companies to be part of that panel. It was really nice to see how companies, how boards believe it is important, and they have changed to adapt to the guidelines we had defined. So it was very comforting to see how boards give an importance and are willing to readapt to protect the best interests of shareholders. So that has been very gratifying. And in terms of also to continue with ESG, as you were asking, we launched last year, towards in the middle of last year, I think it was around October, our green bond panel. So there we took also the global standards from the global bond, GBI, the global bond initiative, the green bond initiative, and the ICMA. We took those standards and adopted them locally, and we already have 6 issuances. Some of them were relabeling of previous issuances. But now the 6 bonds that we have there are all from new issuances. The others have matured already. So it was very nice again to see the interest from issuers. Clearly, also the pandemic has risen awareness, as I was just hearing in the previous panel. Everybody's talking about sustainability. There's clearly a lot of difficulties, and you need to be careful with greenwashing. I agree with everything that was said before, but there's clear a lot of interest from, we see more interest from issuers, you know, to appear that they are sustainable. From the investment side, as of yet, we don't have local investors. The local SEC is working on regulations to launch local mutual funds that are specific for sustainable products. And the way it will work, because I was also hearing about the difficulties of labeling what is a green product. Well, basically, the local regulator has a minimum standards, but our standards to be in the green panel are higher than what the local regulation establishes. So we have gone a notch higher to make sure, or to try to protect as much as possible, this brand of sustainable products. So that's where we are. We think that this will continue clearly because of the interest that has risen. So probably we'll see more launches around this.
Thanks. I wanted to go back a little, perhaps, on something you already touched up on, which was, you know, a lot of changes in regulation and capital controls last year. And in particular, could you perhaps elaborate on how that has, you know, affected companies, what challenges they've faced, and what their response has been to those, you know, tighter capital controls in particular?
Yes, absolutely. Sorry about that. Yeah, so it's been not only tighter capital controls, as you say, but also restrictions on accessing the FX market. So the, issuers who had issued debt internationally in the US and Europe, up until March of last year, if I recall correctly, or maybe it was May of last year, up until that point, they were accessing the official FX market. So in Argentina, the government has established a price on the FX, something that was very common in the 80s, not so common anymore in Latin America. But they've decided, because of the dwindling down of reserves, they pretty much had to establish very tight controls on who can buy dollars locally and for what reason. So at that point, they became stricter with companies and basically told them that they would only sell, I believe it's a quarter, it was 22% of what a company needed to pay interest or capital on debt or on loans they had established with foreign entities. So that clearly meant that they either had to buy dollars at another exchange rate. So for those of you that don't know, you can buy dollars in Argentina by, because on our exchange, you can buy and sell the same asset in pesos or on dollars. So if you buy the asset in pesos and sell it in dollars, basically you do 2 transactions and you get dollars. And there was a very large difference between the official FX market and this other market, which we call contado con liquidación or dollar map, depending if it's dollars abroad or dollars locally in Argentina. So anyway, there was a way, and still is, a way for companies to access dollars at a very different exchange rate. And there was almost, at the point, there was a 70% difference. It then went up to 100%. Now it's down to 54% is the difference between these two FXs. So because it was much more onerous, much more expensive for companies to get those dollars, basically they sat down with their with the bondholders and asked to restructure the debt. That was going on at the same time as Argentina was restructuring the sovereign debt. So I can see how investors that had Argentine assets are not very happy with Argentina because everybody was restructuring them. But bottom line is that most companies were able to restructure successfully their debt. I mentioned YPF. That was a very, that's the largest issuer in Argentina, and it was a very public case. And they were not able to restructure everything, but the short-term debt they had, or actually the debt that was maturing in the short term, I should say, they were able to restructure that. And so most cases, there were a few defaults, but they were just a handful of defaults. Most companies were able to renegotiate that debt. And as part of that renegotiation, they tapped the local capital markets as well. The local capital market, because of the FX regulations, they were very interested in finding assets that would correlate with the dollar, either of the official dollar or the free dollar, as it is called. So a lot of companies issued local debt that they would repay according to the variation of the dollar. So it's what we call dollar linked locally. And that local debt were very successful. They were oversubscribed 10 or even in some cases 20 times oversubscription, because everybody was looking for those assets to hedge themselves. So the issuers the issuers and their lawyers, I'm sure they had very difficult time last year in all of these debt restructurings, but most of it is now done, as I was saying. In terms of going back to the COVID, we also had implemented some tools. We had just done that before as part of our investment in infrastructure. So the issuers were able to send everything electronically for us. Just 2 years ago, they would come around with hundreds and hundreds of pages, printed pages that they would have to bring to the exchange. Thankfully, all of that now is done electronically. We calculated that we save around 250 trees per year now on companies not having to submit their telecontables, their financial statements. So that was our contribution to sustainability as well.
Yeah, absolutely. And Alejandro, unfortunately, we don't have a lot of time today. It's a long day with a few panels, and it has to be a short chat. Would love to have more time, but we've arrived at the final question, and that is, looking ahead. What do you think some of the challenges and opportunities for the Argentine market? And also, what are some of the new trends and developments that you think we can expect to see in the next couple of years?
Well, the biggest challenge is about the macro economy and the closed FX market that has really isolated Argentina. It's always been an isolated country, but now it's even more so, again, going back to the 80s. So that is a big challenge. It provides an opportunity, which is to develop, yes, but also to enlarge the local capital market, because the government is going to have to issue locally. I mean, today they can print money, which they're doing a lot of, or they can tap the local market, but there's really tapping global markets today is totally off. It's not a possibility to this government, and I doubt it will be for the next 5 years because of the recent restructuring. The process was really driven by a hard negotiation, and so I think investors are not happy with the outcome, and you can see that in the prices. It's been one of the few cases in which sovereign debt, after the restructuring, has dropped almost another 50% from where the prices were. Anyway, they will be issuing a lot more locally. They are working with the World Bank. We've been part of a group of discussions on what things need to change for the local government to have a better functioning local capital market. So there will be a couple of changes probably happening in that sense. Clearly, it will, you need an issuer, you need a well-functioning market, but you also need a buyer. So the macroeconomic situation needs to change to create more certainty for those buyers, and that will be really entirely up to the local Ministry of Finance and the local the central bank in order to try to create better demand for the assets they issue. But hopefully this will work. We will be doing our contribution from the functioning of the capital market, and hopefully that will be an avenue of growth. The other thing that we can expect from the local regulator, they have been active in trying to promote. So now I'm talking about the Comissão Nacional de Valores, the local SEC. They have a mandate to also promote the local capital market. They've been launching several types of structures, in one aimed at investing in low-income housing, for example, and there's a tax amnesty going on around that, so maybe some dollars will come into the local capital market to fund those type of vehicles. They're creating, as I mentioned, the sustainability funds as well, so you will probably see more of that. And they are very focused on helping the small businesses. So there's SME type of products that they will also be launching in the next couple of months and probably years. So I think that that's pretty much what we should expect from the local regulations and local policy for the next couple of years.
Alejandro, it's been a pleasure to talk with you today. Thank you so much for taking the time to speak with us, and on behalf of CFA, thanks, and we hope to have you at one of our events again soon.
Thank you, Sophia, and thank you, CFA, for the invitation.
If Martin, Merlo, and Juan Manuel Pazos, if you're there, we'll start with the panel. Sorry for the little delay. We're a couple of minutes delayed. Thank you so much for waiting.
Hello, Sophia. No problem.
Hi, how are you?
Okay, so to everyone participating, thank you for being here with us. And to understand Argentina and to understand regulation in Argentina, really the first step is to understand macroeconomic dynamics. So that is why we're really lucky today to have two experts in Argentina on this topic who are going to talk to us not only about regulation, but also about macro developments and what's going on in Argentina. And before kicking off, let me give you a brief introduction on both of them. Juan Manuel Pazos serves as TPCG's chief economist. His main focus is macroeconomic analysis and developing sub-sovereign and sovereign fixed income strategies focused on Latam. Prior to TPCG, he was head strategist at Puente, leading the research team. His experience includes over 15 years in sell-side research as well as macroeconomic and financial consulting, advancing Argentina's investor base as well as the country's largest firms and the public sector. He holds a degree from the University of San Andres. And we also have with us here today Martin Merlo, CFA, who heads the research department at Banco Comafi. He has 14 years of market experience, having worked as portfolio manager for institutional investors. His experience includes positions in insurance companies, having worked over 9 years in Swiss Medical, as well as private pension funds. He holds a degree in economics from the University of Buenos Aires and a master's degree in finance from Di Tella University. Thank you both so much for being with us here today. And to start off the discussion, I wanted to go back for a minute to some of the points we raised during our conversation with Alejandro Garnet. And in particular, he has been discussing some of the challenges faced by issuers in the past year with new regulations and also with the pandemic. And I wanted to see if you have any thoughts on that, and also the challenges that the national government has been facing in that sense. And maybe we can start with Martin for this question, and then Juan can give us his thoughts.
Okay, sure. Well, Alejandro, I think made a good summing up of the situation. The government was facing both the external debt normalization and the peso curve normalization. This was daunting to start with, and then the pandemic hit, and the financial program suffered a heavy strain, right? In the end, it was covered with monetary emission. And this finally ended being part of the solution for the peso curve, starting with a combination of exchanges, which were not at market prices, but playing on the cooperation game and accepting that this was part of the solution. The government would normalize the peso curve, and in the end, this huge monetary overhang ended up being recycled in the peso curve. This was not free, of course. This came with more restrictions on external assets. This meant a higher gap, a higher FX gap, and more strain. So we had tougher restrictions, a more efficient cepo, which in the end proved part of the solution, thinking of the solution as transitory. So all these pesos were recycled again in the linked curve mainly. And well, this also proved an opportunity for issuers. There was a huge demand to hedge up for the increase in nominality, and well, dollar-linked emissions were a huge boon, and even some issuers could offer inflation-linked debt at very good spreads.
So let me add maybe a couple of points which I think are interesting, especially if we think about going back to fundamentals there. I'll start by saying that one of the biggest conundrums that we need to understand, getting how we got here, is a little bit getting this idea of why we got to this segmented market. Right now, we've got a very clear market in hard currency debt with parities ranging between 30 cents, 35 cents on the sovereign, something in the 60s, 70s for most corporate issuers, and provinces somewhere in the middle. So that's the hard currency space. Now, in the peso space, you're seeing all kinds of parities, things from going above parity, like front-end linkers, and the back end of the linkers curve is trading a significant discount. The curve looks extremely steep. So I think that the key point right now is that this thing that Martin was mentioning, this strategy, ended up monetizing a large extent the fiscal gap, ended up creating, combined with capital controls, ended up creating a segmented market. So now when an issuer comes to a market and decides it needs to finance, it has a very interesting question, which is, what's the kind of variable I'm issuing in? And it's not trivial. So, and there you go, like a 2x2 matrix, right, for issuers, where you will start seeing people falling in. So depending on what kind of final buyer, final beneficiary you're aiming at, you got some kind of determination of what you're issuing. And depending on the tenor on which you're issuing, you got the other side. So people who are looking mostly at the mutual fund industry and short-term debt, those guys are issuing badly. Those guys who are seeking more for the, let's say, for the insurance companies or longer tenors, those guys need to do linkers. Now you could ask, who's doing hard currency? Well, no one. The only guys who are doing hard currency are those who are forced to restructure by the central bank, which is the other big development, right? So one thing that happened last year, and we are used to normalizing things, to rationalizing things in Argentina, but the fact is that the central bank forced every single corporate issuer with debt maturing about 1 million a month to have to restructure 60% of its debt. That's something that never happened. Okay, so historically, corporate issuers have always traded title in the sovereign, mostly because they got either better track record or the expectation of a difference in character, let's say. The way that last year worked was that right now every single corporate issuer in Argentina, to a lesser extent or to a greater extent, is BCRA risk. And that's priced into just about everything. And that has kind of closed the market. Now, the situation right now, let me add a little bit to what Martin said, and I think that's contributing to that segmentation in the market, is that last year we got that boom that Martin was telling was almost an accident. On the one side, I remember that in March when we were estimating, when we were running our March program, and we were running what kind of our model to try to determine how money demand was going to behave during 2020, that's prior to COVID. Our expectation was that capital control should provide additional real money balance, demand for real money balances around 2.5 percentage point of GDP. Now the figure ended up being almost 3 percentage point of GDP that capital controls gave. What happened? Well, the government was smart, and we had a more efficient capital controls than last time around in 2011, 2015, mostly because the government this time linked access to the official FX market to not using the parallel FX market. So at any point you use the parallel FX market for anything, you lose access for the official FX market, either to service debt, which you can still pay coupons through it, or you can, or to import goods. So that gave additional efficiency, and that contributed marginally to the increase in demand for real money balances resulting from restrictions. On the other side, then came COVID. And COVID, yeah, it worked like a massive increase in gross financing needs for the Treasury. It forced a significant increase in monetary financing, but it also generated almost 10 percentage points in additional demand for real money balances along precautionary methods. I mean, it's a known component of money demand that people just don't know if they're going to get another paycheck. They tend to hoard money just in case, and that happened. Now, the snapshot right now is that's diluting, and the government right now is basically battling against the drivers of money demand, trying to get away to prevent money demand from continuing to that. But the fact is, the society is just so long peso that it's extremely hard to prevent further rebalancing of portfolios, right? And that's the main problem that an issuer faces right now. People are long peso, and actually, if you ask them, they would like to switch currencies, they just can't.
Thanks both. So last week we held a call to discuss this event, and we discussed some of the issues that we wanted to discuss in this call. And one of the things you both made an interesting point about was regulation, in particular, how macroprudential tools have been and continue to be used by the government as a way to regulate the FX market. Could you perhaps expand on that? Can you go first, Juan, and then we'll go with Martin to see.
Look, it's nothing new. The Kirchner was doing this since the start of time, right? They tend to use macroprudential policies as cyclical policies. So big problem here is ultimately, this is a pro-consumption model. Okay, so ultimately, Kirchnerism understand that consumption drives votes, and if you want votes, the thing you need is to drive consumption. Eventually, you need to repress savings, and when you repress savings, you start hitting investment and GDP. So eventually, your fixation on driving consumption ends up complicating consumption. At some point, you need to start repressing other ways of saving, because you start repressing savings basically by dropping real rates, but then you need other things. That's when you start using macroprudential rates, okay, or macroprudential policy. Let's remember that the first capital controls introduced in 2011, they were introduced actually as a way for the local IRS, the AFIP, to control tax evasion. They were actually a method where they were restricting FX market for retail savers because it was inconsistent with tax returns. Now, fast forward a couple of years later, and then you got things like using the Competition Defense Board to control prices in the supermarkets. Now, the latest is that they're basically using macroprudential policies, things like parking. Okay, so you could agree or you cannot agree with parking, but it's a thing that countries which are being hit with significant hot money, they tend to use, and it makes sense in some point. I mean, capital controls are not bad per se, they're just another tool in the policymaker's tool set. Now you can use parking, and it makes sense in some cases to use parking. Well, the government is not using parking because it has excess hot money and they're trying to keep macroprudential policy. They're using parking to increase the uncertainty about the way you're running a blue chip swap trade, right? Because they want to increase it. They want you risk to run price risk on a blue chip swap trade. Similar, the way that they're forcing every single company to restructure. They're doing so because they argue that private leverage is just too high and that it needs to be managed. You know, it's not that. It's just that the central bank is penniless at this point. So when you start thinking about it, look, it's the main problem that Argentina has, the main problem why Argentina is showing such a huge failure to both drive a balance of payment surplus or a private balance of payment surplus or to sustain potential GDP growth. And eventually it's the big problem that we have where we cannot develop a sensible capital market, is that policymaker tends to believe that just about anything in the toolkit can be used for cyclical means, right? And there's tools that are appropriate for it and tools that aren't appropriate for it. And once you think that everything is on the table, then you get the 20% discount factor on your sovereign curve. Then you got basically no FDI, no BOP inflows. And that's what we're seeing right now. I think that right now, basically because the government has already exhausted everything in its arsenal, it's using things that aren't appropriate or suitable for what it's trying to do. And that is a big challenge that we're going to have over the next 2 years, because at some point we're going to go into an IMF deal. And at some point we're going to have to sell the record straight, and we're going to have to start using macroprudential policy the way it's designed to be used, and not the way we're using it. And then we're going to have a significant adjustment from where we are to where we need to be.
Yes, I absolutely agree with this, and of course you were one of the first to raise the flag on this issue last year. Argentina's external position is so weak that the dollars aren't simply enough for everyone, and so corporates had to restructure their debt, and more restrictions had to be imposed. This, of course, makes it easier for the sovereign to intervene in the bond market and ease pressures on the FX gap. And this is important on two ways in this year, because one, of course, because the government had to maximize the level of exports that it receives, and a big gap goes against that, of course. And because now the operations that it does in the bond market are actually a way of sucking pesos out of the market, which is also relevant for the challenging financial program in the pesos in the peso curve. But these are all short-term measures. They can be used one time, and eventually, as Manuel says, the IMF will have to come along. There has to be fiscal consolidation, or something that makes the market participants to think that the monetary overhang is temporary, which was perhaps how we started to close last year, and now everything has the can has been kicked along the road once more. But we are on a non-stable equilibrium ultimately.
And thinking about this year and about the government's financing needs, which obviously, the fiscal deficit, the primary fiscal deficit is going to be lower than last year, but it's still going to be significant. And we're in a context where, as you mentioned, there's really no access to external financing. How do you see, the government covering those financing needs, especially since, like Juan mentioned, this market segmentation is sort of like a one-shot solution. It's not going to, have an effect every single year. So, Martin, do you want to start and give us your thoughts on that?
Yes, my first thought is that this already resembles a musical chairs game, right? So the financial program, as we said, is challenging, and that was thinking in 4.5% of primary deficit, which has a clear risk on the upside because of the election year, and because now the second wave of COVID has hit, and that means less income and more COVID-related expenses. But still, if we attain this 4 to 5% deficit, this would imply a high rate of rollover. That is, for example, 150% rollover on amortizations, which are nearly 4% of GDP. So even if the government can issue two points extra of GDP, this still leaves with money printing in the level of 3 to 4% of GDP. So the monetary overhang is still there, and with the risk to the upside, the 3 to 4% will easily be 6%. And the remunerated liabilities of the central bank might climb to 12% of GDP. So this increases the risk that we again started going to this scheme of exchanges which are outside of market prices. So the risk that the government wants to increase public holdings on private balances is non-trivial and is getting bigger. If everything goes well, we'll have another more round, and the excess demand, all the pesos that the government will have to emit because it can't roll over debt, will be recycled again. But there's clearly less and less margin. So I think the peso curve now reflects that stress, and well, the long end of the linkers doesn't look attractive, in my opinion. We're all waiting to see some more pressure there, higher rates. The last debt offering was a huge alert there. The rollover rate was really small, and the government ended asking for more transfers from the central bank than we initially thought. So this little piece that we enjoyed in the peso market, I think it's getting to an end.
Okay, so let me tell you almost exactly the same story, but let me try with some absolute numbers instead of relative numbers. I'm going to try to scale you. Okay, so yeah, I agree. Basically, Argentina, if you looked at the figures in December, Argentina had 3 big challenges ahead of 2021. First, how to balance the BOP. Second, how to cover the Treasury's hard currency gross financing needs. And second, how to cover the peso hard currency needs for the Treasury. Fast forward 4 months, 2 of the 3 problems have been irrelevant, have mooted themselves. So on the BOP side, the increases in the soya prices are basically providing between $6 and $7 billion relative to the baseline. So we don't have an exchange problem this year. The FX market is basically going to be floating. It's going to be okay. It's going to be basically matched inflows. And the central bank is basically not going to lose reserves this year. The hard currency gross financing needs for the Treasury also got sorted out. It got sorted out by two basically one-offs. First, we're going to default with the Paris Club. Argentina is probably going to go into arrears. That's going to happen within the next 4 weeks. And second, the IMF is getting recapitalized, so Argentina is receiving $4.2 billion worth of new limited SDRs. If you take that Argentina's hard currency gross financing needs were 10.7 billion. Once you factor in those 4.2 billion and you basically send the Paris Club into arrears, what's left is just about 2 billion in IFIs, which is going to get renewed because it always gets rolled over. So hard currency gross financing needs are not a problem. So basically what was the big woe about last year, okay, which was hard currency, hard currency, hard currency, this year is basically not a concern. This year is all about the peso. Now, we agree with Martin that we're going to be facing a 4.5% of GDP primary deficit. It's also the name in the number in the budget, except that the budget has a 4.5% of GDP primary deficit on a 32 trillion peso GDP. And GDP is going to be something like 42 or 43 trillion pesos. So the problem is that whereas the 4.5% of GDP that Mr. Guzman put in the budget was 1.6 trillion, the actual primary deficit in Argentina was going to be something around 2 trillion pesos. Now you charge on top of that services, and you start suddenly looking at 4.7 trillion peso gross financing needs, okay? In pesos, just the peso side. Now, that for reference, it's a 4 with 12 zeros after it, okay? Now, let me put it in further. Now, let me the relative number the different way. 4.7 trillion pesos is something like 80% of broad money. It's something like 3 times base money. Okay, so the problem is that the Treasury's gross financing needs in pesos are completely inaccurate this year. Now, you can say, okay, but inside those 4.7 trillion, you are counting in cross-holding. Granted, let me take out cross-holdings. So if I take cross-holding, I strike $1 trillion out of it. I know the BCRA is going to finance around 1.2 trillion. How the hell are they going to get money demand to finance 1.2 trillion with money demand dropping? I really don't know, but that's what the budget says. So let's give them 1.2 trillion in financing from the BCRA. Now that means that between cross holdings and the BCRA, you got 2.1 trillion. Meaning they still got 2.5 trillion in unfunded gross financing needs after you hit the BCRA. That's the risk to the linkers curve that Martin is telling. Okay, you still got 100% of base money worth of unfunded treasury. I mean, after the central bank printed half a monetary base in order to finance the treasury, you still got 100% of base money in unfunded gross financing needs. That's the challenge. On top of that, because let's be honest, if it were easy, it wouldn't be Argentina. So running just fiscal dominance on monetary policy is something Argentina has been doing for 20 years. It's nothing out of the ordinary. No, this year's a little bit different. So on top of a huge fiscal dominance of monetary policy, we're also running financial dominance of monetary policy. So BCRA is basically printing interest, is paying interest on its remunerated liabilities at the tune of 100 billion pesos a month. That's 1.2 trillion pesos a year, or roughly 50% of base money, just on the quasi-fiscal deficit. And on top of that, you're going to have to purchase something like $6 to $7 billion in the FX market. So the BCRA, another $500 billion or $750 billion to purchase the excess in the FX market. So suddenly you got a central bank that's encumbered with fiscal dominance, monetary, financial dominance, and FX dominance. Wow, you know, it's a tough one for the BCRA. Now, how's this going to move? Well, the Treasury is going to be very aggressive in getting market financing. There's no way around it, because the BCRA, and more importantly, it's going to rely almost exclusively on non-bank regulated players, because banks, the BCRA is going to need the balance sheet of banks in order to park more remunerated liabilities. It needs to sterilize boatloads of money, and after sterilizing boatloads of money, it still needs to roll over its quasi-fiscal deficit. So balance sheet of banks is basically compromised by monetary policy. So you need the balance sheet of the rest of the industry, of the rest of regulated players, in order to park treasury liabilities in there. Now, that's the risk. Now, where I disagree with Martin is the idea that this is common to all of the linkers curve. My take is that This is especially problematic for the front end of the linkers curve. You can see that that's where basically the Treasury is concentrating right now, because the Treasury wants to issue liabilities at inflation plus 0, not inflation plus 10 is the back end. So they're basically concentrating 2022 basically for maturities, which means that you're going to have excess supply or a lot of supply risk in the front end of the curve. Now, at inflation plus 10, which is the thing you're seeing in the back end of the curve, and given our base view for inflation, which averages around 3.7% a month until the end of the year, you basically get that the break-even blue chip swap, for you to lose money by the end of the year, if you get an R's discount, it's something like 220 pesos per dollar. You know, it's a long way for the blue chip swap from here to there, especially with the kind of controls the government is giving. And let me give you a quick hint on those kind of controls. Now, let's take the March numbers for a second. Now, the BCRA in March had gross printing needs of around 370 billion pesos. It had to finance 165 billion pesos to finance the Treasury. It had to finance 100 billion pesos for its own quasi-fiscal deficit. And it had to print around 130 billion pesos in order to cover its, to purchase the excess dollars in the FX market. Now, that's 15% of base money. They needed to sterilize. They managed to place LELIQs and repos worth 163 billion. Now that's 7% of base money. So the question is, can money demand absorb an 8% increase in base money in March? Well, of course it can. So how did the BCRA square out the round peg? Well, it basically intervened in the BCS market, and the difference in between the dollars it purchases in the official market and the dollars it sells in the parallel market, it's no longer a way to intervene on the brecha. It's a sterilization mechanism. It's mostly a monetary issue right now. So the BCRA is basically doing as much as it can. It's so stretched that it's about to break. And still, base money increased by something like 1.5% in March, even after they did all that. Now, that's not sustainable in time. That kind of effort is not sustainable in time. So my take is that you still get the BCRA supporting the blue chip swap in the short term, mostly as a sterilization mechanism. You still got the inability of the central bank to increase ex-ante real rates implicit in the monetary policy stance, because doing so would hit against the financial dominance. It would mean increasing the quasi-fiscal deficit further, which would be mostly impossible. And in that context, my view is that the linkers curve is most likely to flatten. The most likely movement for the rest of the year in the linkers curve is a bare flattening of the curve, where the front end is going to suffer because the Treasury is not going to be able to, at the rates it's the curve right now, to raise the kind of money it needs in the front end. The back end is mostly anchored, because you can run a massive carry trade on the back end of the linkers curve, and you would still make boatloads of money by year. So that's where I kind of differ with you, but the rest of it, I fully agree.
Okay, we're coming to the end of our discussion. Unfortunately, we only had a short amount of time to talk with you today. So I'm going to get to my last question and get your thoughts on this. What I wanted to ask you is, and you've both already touched on this topic, but maybe you can give me, your general thoughts, summary of your thoughts on this issue, and it is, what do you think will be the main challenges and also opportunities for the government looking ahead, and if perhaps midterm elections or IMF negotiations could be a potential positive catalyst for valuations? And we can start with Juan Manuel and then get final thoughts from Martin.
Okay, so let me tell you 2 or 3 things which I think at first look perfectly contradictory between themselves, but I'll make sense of them, I promise. So first, I think that the election is not going to be a significant driver in any way. We're heading to elections where my take is that no one's going to win, and no one's going to lose either, in the sense that the government's probably going to get a couple of votes more than the opposition in absolute terms. So they're going to be able to say, I won the election. No one got more votes than I did. But also they're probably likely to lose seats in both the lower and the upper house, which is the real thing that they care. Now, I'm not sure Cambiemos is going to pick up those seats. My take is more that someone else is going to pick those seats. We're going to see voters returning a more atomized Congress that we have right now. So my take is probably there's going to be no winners. So whereas let me compare with the last two elections. So the midterms in 2013 and the midterms in 2017, it was extremely easy to tell who was going to win and who wasn't going to win. In 2013, if Cristina Kirchner got enough numbers to change the constitution, she was staying and she won. She didn't. In 2017, if Cristina Kirchner won, she would have proved herself a viable candidate ahead of 2019, and she would have won. She didn't. Now it's not going to be so clear. There's finding a mandate, finding a clear message for this midterms. I think it's going to be much more complicated. So I don't think they're going to be a significant catalyst. The first real catalyst, I think, is probably going to be an IMF deal. Now, that's not going to happen before the election because the government has no needs to do it. The question is, what kind of IMF deal we're going to have, and that is where I think we get to the point where we're going to see catalysts. So my take, I had published a piece today. One thing that I went into the piece thinking very different than I did when I went out. So when I started writing the piece, I thought that our problem with Argentina was that we were lacking fiscal consolidation over the coming decade. And we are, but it's not the main problem. Okay, so once you see Mr. Guzman's restructuring, services are so low that marginal, let's say 10 percentage points in additional fiscal consolidation over a decade would put Argentina's leverage ratio on a substantial downward path. Okay, so between the baseline that he presented with a 1.1, 1.2% primary surplus as a terminal surplus and something like a 2% primary surplus as a terminal, the difference is monumental and in leverage terms, and still it's not so significant from a fiscal policy point of view. The problem is that Argentina, the policy that Argentina, and also growth, right? Growth is probably, we're already assuming a lot of growth, especially this year and over the coming years, assuming a 2% growth. So we're probably not going to get more growth from there. What I think is the main conditioning this time is that economic policy has had a completely negative impact on the balance of payments. The problem of Argentina, while we think Argentina is potentially going to a second restructuring by 2025, and while the market is pricing with 80% probability that Argentina is going to a second restructuring by 2025, and the reason why recovery levels are 30 cents on the dollar is because the market is convinced that Argentina cannot generate 2.2 percentage points of GDP worth of hard currency free cash flow. And if you look at history, they're right. We've spent for the past 12, 15 years with a hard currency gap. We perpetually need around 2.6, 2.7 percentage points worth of hard currency more than what we're spending. So how are we going to source that kind of hard currency to service that debt? And I think that's the main problem. Now, the only way I see that changing is if we change politics, if we change policies, if we stop using, as we were discussing, macroprudential policies as cyclical policies. Now, my IMF deal might help there. If you look at the most recent kind of deals, the Costa Rica deal, the Ecuador deal, the modern IMF deals, those deals have been very different from the historic. They're very different even from the macro deal. Okay, they got something very interesting. They flipped the thing around. So Argentina, I was just telling you guys, the main problem that Argentina has is that we've got fiscal dominance of monetary policy. That basically means that the BCRA cannot run the monetary policy at its feet because it's encumbered with Treasury draws financing needs. Now, every single modern IMF deal is the other way around. So you got monetary dominance on fiscal policy. Now that's tough to say because we've never heard it. It's so bizarre that almost no country in the world has had that forever. And Argentina, certainly. Before doing that, we usually fire the BCRA president, right? So the way that this works is that the Treasury cannot run the fiscal policy at its feet because it has to support the BCRA balance sheet. How to work that? You put a baseline worth of financing and you put spending caps below the financing baseline, and the excess monies that by program the Treasury would be generated should be siphoned over to the BCRA in order to recap its balance sheet. Now that's something that both the Costa Rica and the Ecuador do. Now that would change significantly the prospect for Argentina. My take is that if you look, that's the blueprint of every single IMF deal. The question that I have is, such a deal would probably be a game changer. It would be probably the first catalyst that we got for Argentina in a long time. Now the question is, can the government support the deal? Can the politics within this coalition get that deal done? And if they sign this deal, because let's be honest, once you face 20 billion worth of maturities with the IMF next year, you're going to sign a deal. Question is, can you see the deal not fall through? Can you actually meet the targets on that deal? Or is it going to be something like the first macro deal that 2 months after you sign it has already fallen through? We'll see, right, from now. But my take is that the first catalyst that we're going to see is the IMF deal, potentially in first quarter 2022.
Yeah, I tend to agree with Juan Manuel. He was very, very clear on that point. Relevant catalyst is the IMF deal. I think the elections will give us a clue on the scope and quality of the fiscal consolidation going forward, and ultimately on the kind of IMF deal that we will have, and that perhaps the most important information we'll get from there is how the tension between the governing coalition resolves itself, because there's an uneasy, well, not truce, Cold War, and it will be resolved one way or another. There will be winners and losers inside the governing coalition, and this can be relevant. Independently of the outcome of the election, there is no way to imagine Argentina without an IMF deal next year. The one-offs that came on this year are that one-offs, and they won't be around. The external position is very weak, and there is no way to go forward without some kind of macro normalization. And well, perhaps thinking on this sense is that when I think of the longer linker curve and the spread they have against the globals, well, if there is macro stabilization, then we have to think on less restrictions, less cepo, and the play will be on the globales and not on the linkers curve, because that spread is simply too big. Of course, if we have another healthy cepo, the long end of the linkers curve will have another bonanza, but I think that liquidity position there is very bad, and though the carry is very great, and I agree with you, Manuel, the spread is good, but it's difficult to think of carry positions there. So just to comment on that, I think that the macro trade will be on the globales, and the long end linkers curve. Perhaps it won't do much damage, but it won't be the winner. So in the meantime, the front end, it will be stressed, but I think part of this recycling of the pesos, while we can't do any other thing, will be focused on the short end, trying to just carry on the short and reinvesting at higher rates.
Well, thank you very much, both of you, for being on this call today and for sharing your thoughts and experiences. I believe Inigo has some final remarks before we finish.
Yes, thank you, Sophia, and thank you, Martin and Juan, for your insights. Let me now give some closing remarks to this first policy series. So I'm Inigo Benguechea, CFA, and I'm the Senior Director for Government Relations at CFA Institute. And I want to start by thanking everyone who participated in our first edition of this policy series for Latin America and the Caribbean. I especially want to thank our keynote speakers, Mr. Daniel Maeda, Superintendent of Institutional Investors for the Securities Commission in Brazil, as well as Mr. Alejandro Garnet, CEO of the Argentine Stock Exchange. Their insights were very much appreciated as we all try to navigate the regulatory challenges that are happening across the region. I certainly hope you all enjoy the presentations and the panel discussions that ensued with very senior industry experts. Their perspectives also serve to provide a first look as to how these ongoing changes are impacting investors and firms. Thus, by combining the perspectives of the policymaker and the industry leaders, our wish is that this policy series helps you improve your understanding of the regulatory change that's happening in Brazil and Argentina. As I said, this was our first policy series, and we created this series with the objective to provide a technical forum for discussion concerning the impact of regulatory, fiscal, and monetary policies on financial markets and the economies in the region, both from a long and short-term perspective. The series is the result of a collaboration amongst 13 CFA Institute societies across Latin America and the Caribbean, and without them coming together, this series would not be a reality. Therefore, my sincere congratulations to them and all our volunteers, especially Melvin Escudero and Hugh Miller, for their leadership as chair and vice chair of the region's Advocacy Council. Let me say that the good news is that we're also planning to do additional policy series in the very near future that will focus on other countries. So please stay tuned as we work together in bringing you high-profile policymakers in charge of driving regulatory decision-making. With that, let me thank you again and wish you a very good afternoon. Thank you.